by the time this month closes, it'll be very interesting. This could be a topping candle, a reversal candle, which signals we're going to see several months bars after this to the downside as it unwinds. So this is what I've been waiting for, is the top in gold, the reset, the financial reset in the markets, and then precious metals are going to be the ultimate buy, in my opinion, once we see gold and silver and miners kind of correct back down, build a launch pad. And then I think we're going to see, incredible multi-year rally in gold again to some astronomical pricing. So that's kind of it from, in a nutshell, based on the monthly charts.
The gold market continues to exhibit choppy and volatile behavior, with prices initially sliding lower before rebounding slightly, following a weaker than expected GDP print from the United States. This data surprise shifted sentiment, giving gold a modest lift, though the overall price action remains cautious. As of Wednesday's European session, gold is hovering just above the $3,300 level, struggling to attract strong buying interest amid conflicting macroeconomic signals. According to ChrisVermeulen of the Technical Traders, gold appears technically overextended in the short term. Based on chart patterns such as bull flags and Fibonacci retracement levels, he anticipates a near-term pullback of around 4%. Once this rally exhausts itself, a deeper correction in the 15% to 34% range could follow, mirroring historical blow-off phases like the 34% drop gold experienced after the 2008 financial crisis. Despite this bearish potential in the near term, Vermeulen maintains that the broader trend remains bullish, with gold likely to resume its upward trajectory once the correction runs its course. At the same time, geopolitical and economic factors continue to send mixed signals. Signs of easing tensions between the U.S. and China are reducing demand for safe haven assets, including gold. Additionally, month-end flows have strengthened the U.S. dollar, creating further headwinds for the non-yielding metal. However, ongoing uncertainty fueled by former President Trump's erratic trade stance and inconsistent updates on U.S.-China negotiations are keeping risk sentiment fragile. Coupled with expectations of more aggressive monetary easing from the Federal Reserve, these dynamics help to limit dollar strength and provide some underlying support for gold. Last week's technical setup also reflected shifting investor sentiment. The weekly candlestick formed a prominent shooting star, indicating growing hesitation among traders. Yet, the disappointing GDP print has disrupted this cautious outlook. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Gold's been on fire. We're definitely in a bullish environment for gold. We're in a very sweet spot, which you and I have kind of covered before. When we take a look at the overall kind of cycle that the markets go through, I believe we're in this topping stage 3 phase. But the key point here with precious metals is simply we tend to see gold do very well just before a major market top. And I believe the market has put in a top. And so this is when gold, silver, and miners generally kind of can buck the trend and really extend. Now, gold is kind of the poster child. It's the one the whole globe likes. It's slower moving, more investment capital moves into it because it's more stable. And so when we actually look at the charts of gold, you can see we've had this huge rally really for quite some time, just continues to push higher. You and I had talked a long time ago about 2,750 to the $1,800 level being a major target. This is going all the way back from the 2015 lows and also all the way back to the 2003 lows. Both timeframes pointed to this as being a significant pause. And we hit that level and we actually saw a significant pause in correction. And so right now we're what I call is kind of like a blow-off phase where we're seeing gold just kind of take off. It's becoming mainstream in terms of it's in the media, hitting all-time highs. And so now it's like we can really just predict forward kind of one little leg at a time using technical analysis, how far gold can run each time it creates a fresh new pattern. And for example, the daily chart shows a really nice pattern. It's hit one of its measured moves, which we were expecting just a couple days ago. And if we use Fibonacci, Charlotte, like you and I have touched on many times, we take the recent low and we go up to this first rally in this tight little pullback. And this is a tight little bull flag. This is a high momentum trade. I was sharing with people as it was unfolding, saying this is a high momentum trade that we should see gold pop all the way up to this one level, which is the 100% measured move. And we've seen that. And now gold's going into a correction. And this is the same type of scenario when gold hit the 2750, 2800 area. Usually we're going to see a very sharp pullback, heavy volume, and then the market needs to digest before it starts to move higher. So gold hit that this week. And now gold has a little bit of a bearish pattern. And based on this recent pullback, using Fibonacci, we can get an idea of where gold could go next week, which based on where it's at right now, we could see gold probably fall another 4% or so. This is a little bear flag pattern, which points to lower pricing. A bear flag is known as the halfway point. So the halfway point from the high, and we can just focus downward where that should go. So we're looking around 31.45 for gold to potentially kind of digest this most recent kind of pop in price. And then from there, we can gauge where that next rally will be, because what this will create is another pullback and a low, and then we can use Fibonacci to kind of stair step where the next upside target is. So you definitely don't want to be betting against gold. Gold is in a bull market. It's in a sweet spot. But the key thing here is, and I don't know if I have a chart of this on me, but there is if we look at the monthly chart of gold, we've got these blow off phases that take place. And if I just go back to 2000, all the way early 2000. So here was a blow off phase, very similar to this blow off phase we're in right now. We also had one over here. And we had one just before the 2008 financial crisis. And we even had one over here. And believe it or not, all of these are about a 22 to 24% push to the upside. And these are similar scenarios where gold has been in a strong uptrend for a long time. And then suddenly everybody piles in and seems to just run it higher as kind of FOMO sets in. And so we have seen gold right now just run roughly 22, 24% to the upside, just like every other time. And so I do believe we're going to see it have a bigger pause and pullback. And I think we're going to go into a bit deeper of a correction, which you and I have talked about. I'm like, gold is in an uptrend, but it will pull back with the broad market when we go into a recession temporarily. And so I think we're going to get into a scenario where it's finally going to start to run into some steam based on this kind of FOMO trade of money piling in at the last minute just before it has a bigger correction, just like in 2008, where gold pulled back about 34%. So I do believe gold is on its this is the monthly chart, the last month or two before we see it stall out and reverse back down and then go into a pause and a pullback that could be anywhere from about 15 to maybe even 34% correction, which, it bucks the trend. Everybody right now is super bullish on gold. They don't want to hear that. They don't believe it. But the technicals are actually pointing to roughly 20 to 34% pullback in gold once it puts in a top.
The recent surge in gold prices has led to a notable increase in individuals considering the sale of family heirlooms and other gold valuables for cash. With spot gold prices reaching an all-time high above $3,500 per ounce last week, many are taking advantage of the record highs to liquidate assets. This milestone comes in the wake of new tariffs announced by President Donald Trump in April, which have intensified fears of a global trade war and the possibility of a U.S. recession. Just a year ago, gold prices hovered between $2,200 and $2,300 per ounce, highlighting the magnitude of the rally. As of Wednesday morning, gold futures were up approximately 23% year-to-date and 36% higher than levels seen a year earlier. The explosive price growth reflects economic uncertainty and increasing demand for safe haven assets. ChrisVermeulen notes that historically, gold, silver, and mining stocks tend to lead the recovery after major market crashes, particularly when miners begin to outperform gold itself. He expects the next significant move in the precious metals sector will likely start late this year or early next, reinforcing the narrative that gold remains a strategic asset amid ongoing volatility and economic concern. Let's get back to the interview.
I just look at the charts and the data. Just the visuals of the data to me paint the picture. I don't need to know all the fake stories or reasons why people think something's happening. So if you follow just the charts, to me, I see unemployment starting to rise. I see interest rates potentially might rise and hurt businesses a lot. I think credit card delinquencies have skyrocketed. Home prices are not. I mean, they're dropping like flies. There's huge supply, and people just aren't willing to buy them at the pricing. So we're going to see a collapse in the housing market. I think the housing market is going to trigger panic among investors because most investors own a property or multiple properties, and it's usually a huge chunk of their net worth. And when they see their home properties or the rental properties dropping hundreds of thousands of dollars in a relatively short period of time, plus the stock market and the bond market, they'll start to panic. And that's when people start liquidating and they're like, I don't know what to do. Just sell everything and move me to cash or move me to gold. But typically when that panic hits in the economy, that's what triggers that panic selling and all assets go down. Real estate, gold, people liquidate everything. And then once the dust settles, it's almost like, you get that initial scare. And once your heart rate kind of comes down and you relax, then you can actually make some logical decisions. But when we enter into a bear market and things collapse, people panic and they sell everything. That is their scare. And then once they've sold everything, they're like, okay, I don't know what to do. I don't trust the system. I don't like the stock market, all that stuff. They're like, they'll just say, just put me into gold. And gold has been performing exceptionally well. In fact, at the pricing it's at right now, I think it's like a way better performer in the long run than the stock market has. So all these scenarios come into play and they're like, I'm going to go into gold. It's big, it's boring, it's slow. It's not, connected to the stock market where I just lost my shirt. So that's when gold bottoms first. We'll tend to see gold, silver, and miners be the first to come out of this correction. And when we see the miners participating and outperforming gold dramatically, then we'll be like, okay, that's the sign that this space is coming to life. So I think that's going to happen hopefully by the end of this year, if not early next year, is going to be that next precious metal wave that, we've all been waiting forever for, it feels like, where miners, you can hold them for 5 or 10 years and they go up hundreds or thousands of percent, and gold will double and triple, I think, from where it is. So that's kind of like the economic data is telling us things are slowing, but it's a huge process. We just have to let the markets and the cycles work themselves out. And it's a waiting game. You really do have to be patient. You can't rush these moves. As much as I know a lot of people, including myself, want to get into miners, you have to sit on your hands and be patient. You got to cherry pick the opportunity and the time. Silver, I'm not a big fan of silver here. I think silver is actually the one I'm really excited about when we start. After we've had a financial correction, I think silver and miners are kind of the play. Forget gold. It'll be like, let's move to the fast moving stuff. But silver took a huge hit with the recent panic selling. I can't remember what percentage wise silver fell in the last month, but gold pulled back 6 or 7%. And we saw silver pulled back about 22%. So, silver is really volatile and it hasn't really recovered. It's at a bounce, but it looks like a bearish bounce. It's an oversold, it's bottom picking, it's people hoping it's going to take off. But really, I think silver has kind of topped out and it's going to struggle to make some multi-year highs. It has a very volatile chart pattern that also indicates longer term it's ready to go down. So I'm not a big fan of silver. Gold really is the one and the only part in the precious metal space I think to be involved in. It's the most consistent. The whole world is buying it, whereas silver and miners are more of a speculative play, and they're more sensitive to fear. As soon as they're selling or a bit of fear, they drop like a rock. We're very small markets. Whereas when there's fear in the world, people around the world actually say, I'm going to buy some gold. So there's a lot of global support, I think, for gold itself. And silver to me is just too fast, too moving, too speculative. And speculative stuff usually has more emotional traders. So they're more inclined to panic and spook and, buy high and sell low. Just they're constantly feeling like they're missing out on a move. They get in and then it drops and they get out because they're like, oh, I timed it wrong. And it's just the way that volatile assets are, usually have more volatile traders, around them.
As shifting monetary expectations and fragile geopolitical developments jostle investor sentiment, gold remains in a turbulent holding pattern, buoyed by long-term enthusiasm yet pressured by technical fatigue and temporary dollar strength. While price action shows signs of fatigue after historic highs, broader structural forces, including concerns about economic contraction, trade policy unpredictability, and the global search for value retention, continue to underpin gold's strategic appeal. Even if short-term volatility prevails, the foundation for a renewed upward phase appears intact, especially as broader asset classes face heightened scrutiny. Could the current price hesitation be the calm before a renewed rally, or is a more profound market adjustment on the horizon? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.